Greetings all, welcome to the part 2 of our study in income from other sources. In this part, we'll be learning about various items of income that fall under income from other sources and their specific treatments. So let's see what all are the items that we'll be covering under this study. First we have deemed dividend, then gift, then cash flow income, family pension, share premium in excess of fair market value, and this is only in the case of a premium issue. Then we have two interest items. First one is interest on securities. Then we have interest on compensation and enhanced compensation. After that, we have two kinds of letting out income. The first one being composite rent, and that is the rent that we receive when we let out a building along with additional facilities. For example, giving out facilities like furniture and various other things along with the building, and we collect a rent together for the building and the additional facilities that we provide. And finally, we have income from letting out plant, machinery and furniture. So these are the items of income that we'll be learning under this study. See, one thing I would like to let you guys know is the order that you see here for the items of income that I'm teaching, that is this order, will not be the exact same order that you will be finding in your study materials. In study materials, it might be in a completely different manner that they have arranged these topics. The reason I rearranged what we see in our study materials and devised this arrangement here is because I found this to be a much more easier and more practical manner in which we can approach this topic. Now with this order, it is much more easy for you to study this lesson. So without further ado, let's start with the topics. First, we have dividend income. Every one of you know what dividend income is. Dividend is nothing but the final appropriation of profit that a shareholder gets, right? In a layman's term, dividend is nothing but the distribution of profit a shareholder gets. Final appropriation of profit which remains for the shareholders, equity shareholders alone, right? So let's see what dividend income is as per the Income Tax Act, and also what the treatment of dividend income is in Income Tax Act and under IFOS. Okay. So first off, the following payments or distributions in bracket cash or kind by a company to its shareholders are deemed as dividends to the extent of accumulated profits of the company. Any distribution entailing release of company's assets. I have also quoted the section, subsection and the clause of all these items. Distribution of debenture stock, deposit certificates, bonus shares to performance shareholders. Okay, that comes under section 2, subsection 22, clause B. Then distribution of liquidation, 222C, distribution on reduction of capital, 222D, and finally distribution by way of advance or loan, that is 222E. So these are the 5 items which qualifies as a dividend as per the Income Tax Act. Okay, so section 2 has all the definitions of everything contained in Income Tax Act, and the definition and explanation of all these items would come under section 2, and hence section 2 is appearing here. But then for IFOS, we only have importance for the 5th item, that is distribution by way of advance or loan, that is 222E. The item of 222E. That is the only item of dividend which is taxable under IFOS. As you might have already learned, dividend income is exempt under section 1034 provided that dividend income is received from an Indian company. And you know the reason why? This is the reason. 1150, section 1150 is applicable if an Indian company pays dividend. So there is dividend distribution tax or commercial distribution tax applicable for any Indian company when they pay dividend. And hence that dividend income being taxed for the company is not taxable for the recipient shareholders. So the company has to comply with section 1150 and pay dividend distribution tax before distributing dividend, and then only the shareholder receives that dividend. So it's the same item of income, and since that item of income is taxed by the company, it is not taxed for the recipient. Okay, but then this is only applicable for an Indian company, whereas for a foreign company, dividend is always taxable and it will come under IFOS. Clear? Okay, so keep this in mind. 222E and dividend from foreign company are the 2 items of dividend that we have taxable as under IFOS. So let's check what actually 222E of the Act tells us. See, it's a term called deemed dividend, and we did learn in the previous slide, I'll just check the last slide, that is a distribution by way of advance or loan, right? But what kind of advance? Advance to whom and advance by whom? So let's check what the act tells us. So it's an advance or loan given by a closely held company. So we got the name, or we got who the party is who gives the loan. Okay, to the extent of accumulated profits will be regarded as deemed dividend if such loan is given to. Fine. So I'm just breaking this portion up before going into the portion where we learned to whom the loan is given. So this portion tells us the loan should be given by a closely held company and it should be out of the accumulated profits. Got it? So given by a closely related company, out of the accumulated profits, to whom? Let's see. To a shareholder who beneficially holds 10% or more of equity shares. Pretty straightforward. So first party to whom the loan given out of accumulated profits will be regarded as deemed dividend is a shareholder who beneficially holds 10% or more of equity shares. Okay. Second, any concern in which such shareholder is a member or partner and has substantial interest. Okay, so the company has a shareholder who beneficially holds 10% or more shares, and this shareholder is a member, partner, or is a party with substantial interest in another concern. Say, imagine the company is XYZ and they have a shareholder, I'm naming him as Arun. So Arun, who is a beneficial shareholder of more than 10% of shares in XYZ company, is also a member of another organization called ABC. And XYZ company gives out an advance or loan to ABC. So that will be regarded as a deemed dividend distribution. Reason being, Arun, who holds more than 10% of shareholders share in XYZ company, is also a member of ABC company. Got it? Now I'm presuming you guys know or remember what substantial interest is. We did learn it in PGBP. Anyway, if you don't, here it is. It is 20% or more voting power if it's a company, or 20% or more in profit sharing if it's any other concern. Got it? So that's the second party. Second party is a concern, whereas first was a shareholder. And finally, any person on behalf of the individual benefit of such shareholder. Alright. So these are the three parties to whom, when a loan is advanced out of accumulated profits by a closely held company, it will be regarded as a deemed dividend under 222E. So closely held company, out of accumulated profits, to three parties. First party, shareholder who holds 10% or more of shares beneficially. And the next two parties are derived from this first party itself. So the next party is a concern in which the first party, that is a shareholder with 10% or more shareholding, has substantial interest or is a member or partner. And finally, the third party is a person to whom we give out this loan on behalf of the shareholder who holds 10% or more equity shares. Fine. So that's what deemed dividend is. But then for a certain class of companies, deemed dividend will not be applicable, and that set of companies are a company which is engaged in the business of money lending and money borrowing. That is a company which is a finance corporation or banking company or anything of that sorts. So with that, we have come to the end of the explanation regarding deemed dividend. Now let's go to the next item, that is gift. Alright, now coming to the second item of our study under IFOS, and that is gift. So what is gift? See, in a layman's term, it is something that we receive without any consideration or compensation, right? Any kind of asset or cash or whatever it is, something that we receive for free, for no consideration or no compensation. So it's more or less the same definition that the Income Tax Act tells us, and let's see what it is. Now, as per the Income Tax Act, it is any receipt of sum of money or property. So two items, sum of money or property, without consideration or with inadequate consideration. So sum of money or property without consideration or with inadequate consideration is treated as gift and charged to tax if it is received by any assessee. So regardless of what the assessee is, whether it's a company, a partnership firm, an AOP, BOI, or an individual or an HUF, it's none of the concern of Income Tax Act. regardless of who the assessee is, if a gift is received in the form of sum of money or property with inadequate consideration or without consideration, and the value exceeds rupees 50,000, then it is taxable. Got it? So the key points here are sum of money or property without consideration or with inadequate consideration, and value exceeding rupees 50,000. Okay, so in such a case, it will be chargeable to tax as an item of gift. Now let's see what the Income Tax Act means by property. Now you do not have to by heart or study all these items by heart or keep this always in your mind. Just read on, and upon doing questions you will get a good idea of what all are the items which will come under gift. So as per the Act, property means the following: capital assets, immovable property being land, building or both. Pretty self-explanatory. I'm pretty sure that I do not have to explain more on that. And movable property such as shares, securities, jewellery, drawings, paintings, sculptures or any work of art, archaeological collections and bullion. So nothing was happening there. A class of assets, both immovable and movable, which can be called as gift and which are categorized as property and can be considered as gift, an item of gift. Alright, so that's it about property. Now let's see what are the different classes of gifts as per IFOS for the purpose of their taxability. Okay, so we are going to learn different situations of gift and their taxability in this slide. So this slide, this part of the video is very important. We'll be learning 5 to 6 sections, and each of those sections will be explaining what are the different categories under which we can treat gift under IFOS. So I suggest you to take notes and give an indication as to an important section or something of that sort. Okay, so let's see what those 5 different situations or categories of gifts are. First one, any sum of money. Okay, gift in the way of money. Second, we have immovable property without consideration. So I've made 2 short terms for property and consideration here, and I'll be using it throughout the slide. Third, immovable property with inadequate consideration. Okay, so both immovable property, first one was without consideration and the second one with inadequate consideration. We learned in the definition, right? Gifts is any sum of money or property received without consideration or with inadequate consideration. Alright, now next, movable property without consideration, and finally movable property with inadequate consideration. So sum of money, immovable property and movable property, and for both immovable and movable properties we have without consideration and with inadequate consideration. Now let's see how or in what manner Income Tax Act tells us to deal with their taxability. So first, for any sum of money, what the Act tells us is, if the aggregate amount received by the assessee from one or more persons during the previous year exceeds rupees 50,000, then whole such value will be chargeable. So if an assessee receives any sum of money from n number of parties, regardless of the number of parties in a previous year, and the sum of money exceeds rupees 50,000, the whole of such amount will be taxable. If in any case, if the total amount received by an assessee in the previous year from n number of people, regardless of the number of people, is below 50,000, nothing will be taxable. But if a single rupee crosses 50,000 rupees ceiling, then the whole of the amount which the assessee has received as a gift will be taxable. So in this case, we aggregate all the transactions in the previous year of the assessee, regardless of the people with whom he has dealt with. It's not a single party transaction that we are aggregating all the transactions. Okay. So for determining ceiling, aggregation of transactions is done. As I said, all the transactions of the previous year from whoever it's received is aggregated. Next, the treatment of immovable property without consideration. So for immovable property, we decide the taxability based on stamp duty value. Alright, so when we receive an immovable property as a gift without consideration, what we do is we check the stamp duty value of the asset that we receive and check whether that stamp duty value crosses 50,000. If it crosses 50,000, then it is taxable. Okay, but the difference here is when compared to the previous learned treatment of sum of money is, here we do not aggregate all the transactions. Here we treat each transaction for the 50,000 limit. Say for example, we are taking the case of an assessee named Mr. John, and Mr. John receives 4 gifts in the form of land and building. And I'm going to term it as land and building A, B, C, D. Land A costs as per stamp duty value comes up to 40,000 rupees. B comes up to 45,000 rupees. C comes up to 55,000 rupees and D comes up to 65,000 rupees. So A and B being 40 and 30,000 rupees is way below 50,000 and it does not have to be considered for taxability purposes. But C and D, which has crossed 50,000 limit, both of which will be taxable. So here what we did is we considered each of those land and building transactions, gift transactions individually and checked whether they crossed the 50,000 limit. And when a transaction crossed 50,000 limit, that individual transaction alone became taxable. See, in the same case where Mr. John received all those 4 land and building assets and none of which crossed 50,000 stamp duty value limit individually, nothing will be taxable. Got it? So only when an individual transaction crosses 50,000 on its own, taxability provisions will be applicable. Got it? Okay, now going to the next category, that is the next situation of taxability of gifts, and that is when immovable properties are received as a gift for inadequate consideration. So in this case, we are paying consideration for the gift that we receive, but then it is inadequate. Now, how do we find whether it's inadequate or not? Compare it with stamp duty value. Fine. So we take the stamp duty value and compare it with the consideration that we have paid, and if the consideration that has been paid is less than stamp duty value, that means there is a case of inadequacy. Alright. Now the taxability here depends upon comparison of the inadequate amount with 2 ceiling limits, not 2 ceiling limits actually, with a ceiling limit which is higher of 2 items. Fine. Now, so what we do here is we find the amount by which the consideration paid is inadequate. Say for example, take a case where we are getting a gift of land and building. Now we are paying a consideration of 3 lakh rupees, whereas the stamp duty value of that gift amounts up to rupees say 3,75,000. So in that case, there is an inadequacy of 75,000 rupees, right? Now let's see what the Act tells us. We'll compare it to this example. The Act tells us that where such inadequacy exceeds the higher of rupees 50,000 or 5% of the consideration, then the difference here is taxable. That is, the inadequacy is taxable. So if the inadequacy amount in question is in excess of either rupees 50,000 or 5% of consideration. So here 75,000 was, in our example 75,000 was the amount of inadequacy, right? So it is definitely higher than 50,000, and 5% of the consideration being rupees 60,000, that is 5% of how much? 3 lakhs. So 5% of 3 lakhs being 60,000 is also lesser than the amount of inadequacy, that is 75,000. So our amount 75,000 is exceeding the higher of these two, which was 60,000. That is the 5% of consideration, and in such a case the difference is taxable. And by difference what we mean is the 75,000 rupees, the inadequacy amount. So any difference between the consideration paid and stamp duty value which exceeds the higher of 50,000 or 5% of the consideration, and then in such a case the amount so which is the difference of the actual consideration paid and the stamp duty value will be completely put to tax. I will quickly explain it once again. So we receive a gift and we make a consideration for it. We pay a consideration and the consideration is less than the stamp duty value. So what we do is we take the difference of our consideration and stamp duty value and see whether it is higher than, whether it exceeds the higher of rupees 50,000 or 5% of the consideration that we have paid.
So we take the higher of 50,000 to the 5% of consideration that we have paid and see whether the excess of stamp duty value over consideration is higher than the amount that we have calculated. And if it exceeds, then the difference is taxable. And again here we take each transaction individually, just like we took over here in second situation. Got it? So no aggregation happening here. So 4 transactions, say imagine a case where an assessee has 4 transactions of gift received, immobile gift received for inadequate consideration. Consider each of those transactions individually and see whether the difference exceeds this criteria. And if any of one transaction exceeds this criteria, then that transaction alone will be put to taxability. Fine. But then there are possibilities that we have more than one stamp duty value when it comes to transactions of immobile property. And the case in which that happens is the date of agreement of transfer and the date of registration are different. And in such a case, what we should do is, as in which stamp duty value we have to take is the stamp duty value as on the date of agreement, provided an advance is paid in any mode other than cash on the agreement date. So when we have a case where we have 2 stamp duty values, that is a case where date of registration and date of agreement are different. In such a case, what we should do is we should take the stamp duty value as on the date of agreement, provided some kind of advance has been paid on the date of agreement and the advance has been paid in any mode other than cash. So that's it about the treatment of immobile property and its taxability when it comes to IFOs. Now let's move on to movable property. And for movable property also, we have a case where it's received without consideration and a case where it's received for inadequate consideration. So let's see how we treat them. So when it's a case for inadequate consideration, that is a free gift movable property, all that we do is aggregate all the transactions. Okay, so we are aggregating all the transactions of an assessee in which he received a movable property as a gift. And what is the value that we are aggregating? The FMV, fair market value. So aggregate fair market value of all the movable properties received by the assessee in the previous year as gift, and if the aggregation exceeds rupees 50,000, the whole amount will be taxable. Got it? Just like any sum of money. Fine. Pretty simple. Just aggregate the FMV of all the movable property received by the assessee in the form of gift, and if it exceeds 50,000, the whole amount will be taxable. Now for movable property received with inadequate consideration, what we do is, again, we aggregate. But what do we aggregate? We aggregate the difference between the actual consideration paid and FMV. And if that difference exceeds rupees 50,000, then such whole difference will be taxable as gift. Got it? I'm assuming you understood the treatment of this, and if at all, if you have any doubts, as I told in the previous video, please feel free to write to me. Please contact me and I'll give you a better explanation if you require. Okay. So that is it about the most important part of taxability of gift. So these are the 5 cases, and I hope you had a really good understanding of all these 5 cases. Right. So again, giving a quick summary. Here, aggregate all the transactions, and if it crosses 50,000, tax. Same over here. And here also same, but then we are aggregating only the difference. But in these 2 areas, we do not aggregate. Instead, we take individual transaction wise. So that's it about this lesson. We'll go to the next topic in gift in the next slide.
So in this section, we'll be learning about certain exempted categories of gift. So certain kinds of gifts which will be considered not to be taxable if they fall under the following categories. Now let's see what are the following categories, as in what are the categories under which if we receive a gift, it will not be taxable. So Income Tax Act says any sum of money or property received from the following shall not be treated as gift and should not be taxable. Let's see what the first classification or first category is. So a gift received from a relative. Alright, pretty basic. Now, what's crucial over here is who can be treated as a relative. See, a basic reading of your dictionary would tell you that a relative is a person who's related to an individual by blood or by marriage. But then that is not the case when it comes to Income Tax Act. The Income Tax Act has a specific categorization of
who all can be treated as an individual's relative. Now, let's see who all would fall under that category of Income Tax Act. So first of all, relative means spouse. So spouse of the individual, pretty clear. Siblings of self or spouse. So siblings of the individual or siblings of the individual's spouse. Fine. Any lineal ascendant or descendant of self or spouse. Pretty clear. Nothing much happening there. Siblings of parents. Alright, your uncles and aunts and everyone who are related as a sibling to your parent. Finally, fifth one, spouse of 2 to 4. By 2 to 4, what I mean is the category is 2 to 4. So spouse of your sibling or your spouse's sibling, spouse of your or your spouse's lineal ascendant or descendants, and finally spouse of your parents' siblings. Alright, so these are the parties who can be treated as relatives for an individual, whereas for an HUF, a relative is any member. Fine, so if you receive a gift from any of these people, it is exempt from tax. Pretty clear? Okay, let's see what's the second category of exempted gifts. On the occasion of marriage. Alright, so on the occasion of an individual's marriage, if he or she receives any kind of gift, it is free, it is out of the purview of tax. Fine? Third one, received by will or inheritance. Pretty straightforward. An asset or property or money or sum of money or property, whatever you receive as a result of a will or inheritance. Fine? Received on contemplation of death of payer. Nothing much happening there. Pretty basic. From local authority. Okay, anything that we receive as a gift from our local authority can be treated as not to be taxable. Fine. From charitable institutes under section 12AA. So, better reading of 12AA will tell you what all other charitable institutions which would come under this section, and this is not so important for you to know what all are the charitable institutions for your intermediate level, but then for final you will be learning this in detail. And then we have from any fund, foundation, university, hospital, medical institution, any trust or institution which is referred in clause 23C of section 10. So as a shortcut, all I want you to do is remember these sections 12AA and 23C of section 10. So if at all you see in your question a gift or sum of money received or property received from 12AA or an institution under section 12AA or any kind of institution, let it be fund, foundation, university, whatever it is, which is set up as per section 10 clause 23C, right away remember it is an exempted category of gift. Okay, so the rest is pretty simple to remember: relative, marriage, will, inheritance. Now these are things that would normally happen in everyone's lives, as in they might be knowing these kind of incidents happening in their family or to themselves as well. So relative, marriage, will or inheritance, fine. Then contemplation of death of payer, and then local authority. That's it. Pretty basic. So with that we have come to the end of gift, this section of gift. Now before going to the next item of income under IFOS, let me give you a quick summary of all that we have learned. But then more than a summary of what that we have learned in this lesson, I am going to sum up the term gift under all the heads that we have learned till now. Okay, so let's check that summary. So first of all, gift, it can be termed into or categorized into three places or three heads of income. Let's see how that happens. The first place where a gift can come is under PGBP. So PGBP gift. Now this gift will normally be taxed under section 28, whether cash or kind. Fine. If not taxed there, it will be taken to IFOs. Alright, pretty clear. Next, an employee can receive a gift from the employer. Alright, now we did learn about a gift under perquisites under income from salaries, right? Now, there we learned any gift which the employer gives the employee in cash is fully taxable as a perquisite in income from salary. Okay, but then any other kind of gift would be taxable if the value exceeds rupees 5,000 in the previous year. Fine. So gift in kind fully taxable if aggregate value received by the employee in the previous year exceeds rupees 5,000. Fine. Now finally coming to the other gifts, that is the set of gifts which would come under IFOS, and let's see how they are going to be treated. First of all, any specified property taxability will be as per what we learned under the 5 categorizations, where we learned that basic limit of 50,000 and how things can be taxed, and we learned how sum of money will be taxed, how immobile property received without consideration, immobile property received with consideration, and movable property without and with inadequate consideration will be taxed, right? So that is the first leg in taxation of gift under the head of other gifts. Now finally, the gifts from relatives, not taxable. So this here, right here, gives you a quick snapshot of what different kinds of gift that would come under Income Tax Act. So PGBP, tax under 28, if not, take it here. Employer gift, cash gift, fully taxable. Gift in kind, if exceeds 5,000, fully taxable. Other gift, specified property as per what we learned previously, and then gifts received from relatives which are not taxable at all. Not so difficult, right? So these categorizations of everything under the gift, all you have to do to memorize them pretty easily is just go through these slides that I've prepared and make these charts on your own in your notebooks. Now when you draw something or when you write something out, it is better for your brain to register it in your memory. So I suggest you to do that, as in draw all these diagrams out in your books so that you can easily memorize every kind of categorizations that come under the study. Alright, so with this we have finished gift. Now we'll go to the next item of income under IEFOS. Now let's see what that is.